Now, looking at your numbers sequentially, there has been an improvement in your earnings, though on a year-on-year basis, we're yet to see that decisive bounce back. Would you say you're almost back to the pre-COVID levels?
So thank you for having me on the show today. I think that, Q3 has been good in that if you look at the peak, let's say where we were in Q4 before COVID, and the trough, which is maybe where we were somewhere halfway through Q2, we're halfway back to the peak at this point, both in headcount and revenue. And we are seeing sustained market traction. Q3 was an unusual quarter for us because usually Q3 sees a lot of seasonal demand for festival hiring, which we didn't see this time. But the kind of hiring we are seeing is more secular, long term. Our general staffing business has seen headcount grow 5%, so it's also exiting Q3 higher than Q1. So overall, we're positive. We're very positive.
Okay, so what has been the impact then of the large-scale job losses on your margins? Give us a sense of the margin picture for Quess Corp going forward. Will the recovery here remain very gradual in nature?
So, I think if you look at our margins, our EBITDA year on year is down 16%. But if you add back, there are two businesses, two BUs that are still impacted by COVID in Q3. One is our training and skill development business, which could not open up. And the second is our food business, because education institutes and IT services buildings are shut. There was no food. So if you were to normalize for that loss, actually our EBITDA has been flat year on year, despite, let's say, a 6 to 7% lower revenue. So I would say that the margins are actually, the underlying business margins have improved on the back of some of our efficiencies. Yes, there has been price pressure, but I think we've more than offset that through a lot of the efficiency improvements we've done. If you look at the pace of the recovery, I think we would all like it to go faster. I think the reality is that the demand is coming back faster in some pockets than others. We're seeing telecoms, BFSI, manufacturing start to kind of kick in, whereas, some parts of retail will probably take a little bit longer to come back. So it is a little bit, I think how you feel depends on where you sit.
Okay. Tell us the total headcount as well at the end of Q3, specific sectors that have seen a pickup, those which have seen a demobilization as well of employees.
So, no, absolutely. Look, I think for the first time, one of the interesting things is our global technology solutions business is our largest business in terms of EBITDA. And I think that reflects the strength of recovery around customer service, around transaction processing across sectors. So that is something that is a point to note, which is at least the business process outsourcing is coming back a lot faster. I think in the rest of our businesses, what we see is that banking, telecoms are certainly back to pre-COVID levels of sales activities, are certainly sort of investing in growth, at least the leading players there. Manufacturing is sort of getting back to normal, and we're starting, we're very hopeful. I know you were just talking about Atmanirbhar Bharat. We're hopeful that will also give further tailwinds in the quarters going forward.
Okay. Okay, the revenue growth in the facility management segment as well. Let's talk about that. Give us a sense of the impact on your numbers, how you stand currently vis-a-vis the industry, outlook on revenues, on EBITDA as well here on.
No, sure. So look, I think the facilities and security industry, we're very bullish about the medium-term prospects of this particular segment. I think the reality is that there is growing formalization. Through COVID, a lot of our potential customers have realized that there is certain reliability that comes with large brands, and we hope that the new labor laws will further accelerate that. And we're continuing to invest in building sales capabilities, verticalization capabilities, improving productivity to distinguish our services. And we've seen 70 plus clients acquired in the first 3 quarters of this year in that business, with a lot of bundling increasingly going on between facilities and security. So those are the good things. I think that Q3, we've not seen growth come in Q3, and that's largely because even as we added a lot of clients, this about 30% of our EBITDA in facilities and security pre-COVID came from education and IT services. And education institutions obviously have been shut. They're now progressively opening up. And IT services continue to work from home. We're starting to again see early orders around ramp up, but I suspect that could take 2 or 3 quarters to fully come back. So in the meantime, we're all a full court press to grow, to acquire new customers. And as and when ITS does bounce back and we are all back to school, I think that'll just end up lifting the boat a bit further.
Right. Suraj, tell us a little bit more about your rapid debt reduction in the quarter that has clearly enabled a net cash position versus a net debt same time last year. What is the outlook now when it comes to debt reduction going forward?
Sure. No, we're very pleased. We're very pleased about this. We've reduced our gross debt by about 621 crores in the last 3 quarters. I think it's come on the back of a lot of hard work around tightening our cash management and making sure we get our tax refunds in. So at this point, as you say, we are a net cash company as of Q3, and I think it's a good feeling to be there, and it's good to see the rewards of the hard work. Also, the other point I would make is that our operating cash flow to EBITDA ratio exited about 80% in the last quarter versus maybe I think about 53% a year ago. So we've gotten a lot better at converting our EBITDA to cash. Look, our focus continues to be on paying down debt. It's our number one capital allocation priority, and you will see further progress in the coming quarters.
Sure. Also wanted to understand that the company underwent a technology-enabled transformation, helping make employees more productive, streamlining the back office processes as well, and creating effective business pricing models. How has that worked so far, and the thrust that you're going to give on the importance of technology in a growing company such as yours?
Look, I think that we are in chapter 1 of a very long book on technology, right? I think we've made good progress in the last year. As a company, we understand that, where we need to be an HR tech firm before we can be a successful HR services provider. We think about our digitization in 2 parts. Part number 1 is what we call the hire to retire process, where we've built a series of digital assets that help us do our work more efficiently from a hiring perspective, onboarding, compliance, and payrolling. And we've got that completely flow through right now, and we continue to make investments. We think we can get even better there, and we think we need to. So that's the first part, hire to retire process. The second part of where we're making investments is really in frontline employee productivity to make sure what our people do, they do better. To some extent, that is about digitization and tooling. So, for example, our home-built workforce management tool, it's called Work, W-O-R-Q. It has about 220,000 MAUs growing every quarter. We use that to make sure we kind of train people, manage workflows better, but also just driving training, better SOPs, and so on and so forth. I believe there's so much potential in India to get better there. You'll also note we've just made an investment in Taskmo. We think that what Taskmo does, they're a platform that enables task-based work in the grey-collar segments. It's something that our general staffing business has been doing more and more of in the last few quarters. And we think that, given the new labor laws, given that gig and platform-based work is now formally recognized in the laws, we think that the proportion of task-based work in the economy is only going to go up. And we want to make sure that we're leading that change also. So we're very excited about that as well.